Hello and welcome. Today we will talk about volume spread analysis. I'm showing you how to read the market before it moves and you will learn to anticipate where the market is going next based on simple logic and the power of volume and the price. So if you could like and subscribe to the channel and stick around to the full video. When using VSA, you should be looking for two things. Whatever the price has been validated by the volume, or whatever there is a divergence with the price. If the price is validated, then this confirms a continuations of the price behavior. By contrast, if there is a divergence, then this is sending a signals of the potential change. These are the only things we are constantly searching for in VSA: validation of or divergence. Before we begin, I want to recommend you a book. And currently it's called A Complete Guide to the Volume Price Analysis. I highly recommend this book. Now let's future discuss validations and divergence. In this example, we have a wide spread up cancelled with a small wicks on the top and bottom, and the associated volume is well above average. So the volume is validating the price action. So let's assume each candle represents one trading day, which is also my preferred time frame for VSA. In this case, we have the market which is bullish and has risen strongly in the trading sessions, closing just below the high of the sessions. If this is valid move, then we would expect to see the effort required to push the market higher reflected in the volume. Remember, this is also like third law of effort as a result. It takes effort for the market to rise and also takes effort the market to fall. So if there has been a large change in the price in the session, then we expect to see this validated by a well above average volume bar, which we have. Therefore, in this case, the volume validates the price, and from this we can assume two things. First, that the price moves is confirmed and has not been manipulated by the smart money or markets. Makes a second. For the time being, the market is bullish, and until we see divergence signaled, then we can continue to maintain any long positions and we may have in the market. Here we have an example of the narrow spread candles formed on the low volume. In this case, the price has risen, but only marginally higher, and the spread of the candles is therefore very narrow. The wicks to the top and to bottom are once again small. The associated volume is well below average, and in one again validating the price actions. And the reason is again because of effort and result. In this case, the market has only risen in the price by a small amount, and therefore we would expect to see this reflected in the volume, which should also be low. After all, in effort and result validating one another to effort required to move the market a few points higher, the result should only warrant a small amount of effort to the volume. So once again, we have a true picture with the volume validating the price. Here we have our first divergence. It is clear we have the widened spread up candles, and if we follow Wyckoff's third rule, then this result should be matched by an equal amount of effort. What we have instead in the big result from little effort. This is a divergence. For a wide spread up candles, we would expect to see a high volume bar, but here we have a low volume bar. If we were in a long positions in the market and this appeared, we would immediately start questions. What is happening? Why this divergence appeared? Is it an early warning of the possible trap? This is a pattern which often occurs at the start of trading sessions in equity markets. What is happening here is that the smart money are trying to feel out the sentiment in the market. The market opens, then the price is pushed higher to test interest in the market for the buyers. Once again, this is the signal of the potential trap. The move higher is not a genuine move, but a fake move designed to stark traders into the weak positions and also take out stops before reverting sharply and moving in the opposite directions. This is why VSA is so powerful. Volume and price together reverse the truth behind market intentions. In this example, we can see a narrow spread candles with high volume, which once again is another divergence. As we saw earlier, a small increase in the price results should only require a small increase in the volume effort, but this is not the case here. The small price increase has been generated by a huge amount of the volume, so clearly something is wrong. There is only one conclusion we can draw. The market is starting to look weak, and this is the typical pattern that starts to develop at the top of the bullish trend or the bottom of the bearish trend. For example, in the established bullish trend, the market opens, starts to rise a little, and buyers are now starting to take their profits at these positions are closed out. More eager buyers come in, but the price never rises as the long continue to liquidate and take their profits, and the cycle repeats throughout sessions. What is actually happening is that the market has reached the price at which future effort does not result in the higher prices, as each wave of the new buyers is met with the long selling out at these levels and taking their profits off the table. So there is no suitable move higher in price. In other words, what is combinations of price and volume is revealing is weakness in the market. Now, VSA is only part of the story. You need to use a variety of other techniques to confirm the pictures and provide additional validations. The most important of these are support and resistance or supply and demand areas. This is where the market is pausing before reversing. Alternatively, it may simply be the pause point in a lower term trend, which will then be validated by our volume analysis. A breakout from one of these regions of consolidations coupled with volume is always a strong signal. Trends are equally important. Wherever you see a divergence which sets the alarm bell ringing, the first step is to establish where you are in any trend. For example, are you at the possible bottoms where perhaps the market has begun selling off or for some time but is now looking at the major reversal, or perhaps you are in the middle of the trend and you are experiencing a minor pullback or reversal in the long-term trend. Deciding where you are in the trend is where you bring in some of your other analytical tools, which then help to complete VSA. In judging where you are in the trend and potential reversal points, you will always be looking at support and resistance candles patterns, individual candles or trend lines. All of this will help to identify where you are in the price actions on the chart. In this example, we have a bullish trend developing in the rising market, and what is obvious is that rising price are followed by the rising volume. This is exactly what we would expect to see. The first candle forms a narrow spread up candles with a low volume, which is fine. The volume validates the price, no divergence here. The second candle is, then begins to form the spread of this wide than the first. And based on Wyckoff rules, we expect to see greater volume than on the first bar, which is indeed the case. So the uptrend is valid, the volume has validated the price on both candles. By the time the third candle starts to form and close with the spread, which is wider than both the first and the second, we should expect the high volume bar, which reflect Wyckoff's third law of effort result. Once again, the price actions on the candles has been validated by the volume. The three candles themselves are now validating the price trend. The price over 3 bars has moved higher, developed into the trend, and the volume is rising and now validating the trend itself. In this example, we have what appears to be bullish trend with the first narrow spread candles followed by relatively low volume. This is fine as the volume is validating the price and is in agreement. The second candles then forms and we have slightly wider spread candles than the first, but with the high volume. This appears to be divergence. With high volume, we would expect to see the widespread candles. Instead, we only have candles which is mainly wider in price spread than the previous candles. So this is our first sign. The third candles then forms and closes in widespread candles, but with volume that is lower than the previous candles, given to spread of the bar. It should be higher, not lower. Another warning signals the fourth candles then forms and closes as a very wide price spread, but the volume is even lower. We now have several divergence here on second candles. We have modest spread in the price, but high volume. The market should have risen much further given the effort contained in the volume bar. This is the signal potential weakness during the third candles. The price spread is wider than the previous candles, but the volume is lower. The buying pressure is draining away. Also, we have a market that is rising, but the volume has fallen on these candles. Rising markets should be associated with rising volume, not falling volume. During the fourth candles, we see future confirmations that the volume and the price on this trend are no longer in agreement. We have the widespread up candles and even lower volume than the previous candles in trend. So the failing volume is confirming what we have divergence on the trend as we expect to see rising volume with the rising trend, whereas here we have failing volumes, a rising trend. What are the conclusions? The problem starts with candles too. Here we have effort but no equivalent result in terms of the associated price actions. This is therefore the first sign of the possible weakness. The market is known as overbought. The sellers are moving into the market, sensing an opportunity to short the market. This creates a resistance to higher price, which then confirmed on the third and the fourth candles, where the volume is failing away. Smart money have this weakness and are starting to see preparing for the move lower, but continue to mark price higher to give appearance of market that is still bullish. It is not. This may only be temporarily paused and not a major change in trend, but nevertheless it is a warning of potential weakness in the markets. The thing's volume is a result of an increasing number of buyers closing their positions. and taking their profits. Wish list, the remaining buyers do not have sufficient movement to the market. Their smart money are also selling at this level, draining to the volumes. This is the reason why volumes fall on the next two candles as they continue to mark the market higher but are no longer involved in the move themselves. They are trapping traders into the weak positions. The initial weakness appeared on the candles 2, which was the future confirmations by candles 3 and 4. This is often the sequence of events that unfolds. Initially, we see divergence that appears using the signal cancel analysis. We then wait for other candles to appear and analyze them against the initial divergence. In this case, the divergence was confirmed with price continuing to rise on falling volumes. And now we have market which is appearing to be weak and confirmed as such. The next steps is to move to the final levels in our analysis, which is to consider the analysis in the bigger pictures of the chart. This will determine whatever what we are seeing in a minor pullback or the pre-course to change in trend. If this market seems, make sure you watch our other VSA tutorials. If you found valuable, like and show your support, subscribe to our channel. Until next time.